Thanks all for joining. We're just going to give it 30 more seconds for everyone else to join the call. Okay, let's kick this off, and then thanks again for everyone who's joining and already joined. So welcome all to the special webinar organised by Saxo and Morningstar, where we will deep dive into the secrets between two of our successful equity portfolios in our SaxoSelect managed portfolio range. Saxo Morningstar MOAT and High Dividend strategies are on the agenda for today. They're tailored uniquely for you as Saxo clients, accessible exclusively from our Saxo platforms. We've got a jam-packed schedule for you today, and very shortly we'll deep dive into how Morningstar's approach to investing can help grow your wealth. But quickly, let's look at the performance numbers, which are all net of fees, which means after costs. Saxo Morningstar MOATs are up just more than 99% since its inception in July 2016, and 14% above its benchmark. Morningstar High Dividend up 42% since inception. Saxo and impressively up 4% this year, a 12% gain over its benchmark. But of course, past performance is no indication of future performance, but I hope it gives you some insight into the ability of the portfolio management team. I'm just going to share my screen here. Bear with me. Okay. So we have Mark Preskett, Senior Portfolio Manager from Morningstar, bringing over 15 years of investment management experience to the table, and today serves as Lead Portfolio Manager for Morningstar MOAT Solutions, amongst many others. And previous to Morningstar, Mark worked at AIG Life as an investment analyst, gaining his CFA qualification, and holds a degree in politics. And just to keep you on your toes, we've got another Mark in the call. That's Mark Murray. He's a senior investment analyst for Morningstar Investment Management, and previously worked in Tatton Asset Management, specialising in small cap equity research. Mark holds a master's in politics from London School of Economics and holds a CFA qualification. Please all listen to the next slide. It's Saxo's risk disclaimer. I'm not going to read it all for you, but do note that investing involves risks, including risk of loss. Past performance is no guarantee of future results. And before investing, please consider your investment objectives, time horizon, and risk appetite. So the agenda today, firstly, introduction to Morningstar Investment Management. Who are Morningstar? What's their heritage in investing? Then how economic moats guide Morningstar's investing style. And we'll take a deeper look at the MOAT portfolio, then take a look at high dividends, and finally, why investing in Saxo Morningstar portfolio can impact your wealth. And whilst I remember, please note you can write your questions at any time. I think it's in your top right-hand corner of the screen during the presentation. I'll then fish out the most interesting ones and ask them both to both Marks at the end of the call. Without further ado, I'll hand over to Mark Preskett to take us through the first section of the webinar.
Great, thank you. And hi, everybody. Thanks so much for sparing the hour this lunchtime to listen to us talk about our MOAT portfolio. So firstly, Morningstar Investment Management. Our organization is global. We have around $250 billion assets under management and advisement, with over 600 employees and around 100 investment professionals. We operate out of 3 main hubs. Our head office is in Chicago. We have 3 offices in EMEA, Paris, South Africa, and London, and also presence in Australia and Asia as well. And you can see the split of the AUMs there. We predominantly work with financial institutions and financial advisors across the world, delivering long-term investment, sound long-term investment results for our clients. We also have our research analysts that are the sort of the engine behind this product. So Morningstar Investment Management have created these portfolios and partnered with Saxo, and they are unique to the Saxo platform. And then the DNA and the fundamental research is provided by our analysts. So in this case, our equity analysts who are based all around the world, delivering stock research to asset managers, sovereign wealth funds, private banks, etc., and also to Morningstar Investment Management themselves. So what is economic moat investing? So one of the beauties of leveraging off a independent research team internally is that we have one process, one valuation methodology, and one way of looking at stocks across the whole universe. So we have 120 equity analysts covering around 1,500 stocks globally, and looking at and analysing stocks under one sort of valuation methodology. And we're very concerned with the Morningstar fair value. So every stock that is analysed, there's fundamental research taken on those stocks, and also discounted cash flow modelling to create a Morningstar fair value. And it's that sort of forms the bedrock of our portfolios that we've built for Saxo over 6 years ago. This just sort of shows the breadth of coverage. So those 1,500 stocks across regions, across market cap, and across sector. And the analysts themselves are structured by sector and looking to sort of analyze stocks not in isolation, but relative to their peers, to try and identify the best value out there. So what is economic moat? I've included a couple of quotes. The first from Michael Malberson, who's currently the head of Consilient Research at Morgan Stanley Investment Management, but has also worked at Credit Suisse and Legg Mason. He writes that companies generating a high economic returns will attract companies willing to take a lesser, albeit still attractive return, which will drive down aggregate industry returns to the opportunity cost of capital. I.e., winners are there to be targeted by competitors, and it's very difficult for companies to sustain supernormal profits over the long term without some sort of barriers to entry, and what Morningstar describes as an economic moat. And underneath is Warren Buffett, who is the first to use the term moat in sort of an investment context. So I want a business with a moat around it. I want a very valuable castle in the middle, and then I want the duke who's in charge of that castle to be very honest and hardworking and able. And then I want a moat around that castle to keep competitors away. So Morningstar has 5 sources of economic moat that allow a company to generate positive economic profits for an extended period of time. And we've defined those as intangible assets, switching costs, network effect, cost advantage, and efficient scale. And as you can see from below, and with the percentages, not all companies have an economic moat. So of the 1,500 stocks that we cover, around 40% don't have a designated and no moat rating, 45% narrow, and 16% wide. And wide are the biggest sources, the widest and the strongest moats that allow economic profits to be sustained for a longer period of time. Narrow, slightly less strong, and the competition can eat into those profits at some point. And I've put up a slide here summarizing some examples. I won't go through them all today, just given we've got the time constraints, but I thought I'd touch on a couple of the sources of economic moat. So firstly, intangible assets, which is, the most well-known, and ultimately it's a brand. It's that sort of je ne sais quoi that allows a firm to be recognized on the street and globally. And Coca-Cola is a great example of a wide moat firm. Ultimately, they're just selling sugar water, carbonated sugar water, but consumers are willing to pay a significant premium for that, and the brand is well known. Adidas in the shoe industry, again, another well-known brand, very popular with for its sportswear. Yeah, it's a very competitive marketplace, and we've designated this as narrow, just driven by that. There are a number of other brands out there and that competition is extremely strong. And then finally, United Airlines. So we know the name, but would we, as consumers, pay a premium to fly United over Singapore Airlines, etc.? We don't think so. We've designated that as a no-moat rating. And other examples are, from a brand is in the auto sector, where we have very few wide and narrow moat firms. Ferrari we've designated as a wide moat firm, but for many of the car companies, they're designated as no moat. The other example that's quite interesting is the network effect, where we have MasterCard here as a wide moat. So each additional user of the MasterCard brand increases its value to the others. So it is a very strong and powerful network that people are willing to pay for. Lyft is in the sort of driver sharing market alongside other operators like Uber, and it does have a powerful network. It's very dominant on the east coast of North America, connecting drivers and riders in a sort of virtuous circle, and we designate that as narrow moat. And finally, Deutsche Telekom, a very large network of users, but despite its scale, it's never been able to generate returns significantly above its cost of capital, and that switching effect is still very prevalent. So that's just dipping into the sort of how we think about firms. So we're looking at investing in these economic moat firms, and that is the sort of the sample, the base of all of our investments processes. What have we done with that research? We've built two portfolios, a growth and an income portfolio, both investing in 30 stocks and both available in two currencies, Euro and USD. We have this investment process, a long-term approach, trying to keep turnover to a minimum. We're only investing in wide and narrow moat stocks. And for our growth portfolios, we're looking to invest in those wide and narrow moat stocks with attractive price to fair values. And we're trying to diversify across sector and geography to build a truly global portfolios. As I tried to explain, the engine behind this is Morningstar, a renowned and trusted independent brand. We have a global investment team. We've got award-winning investment processes. We're also leaders in data, ratings, and research. And growth this year has been a difficult year, but we've continued to go from strength to strength in 2022. And finally, what the benefits? Ultimately, we have the portfolios have delivered. They've generated very competitive returns relative to benchmarks, and in an absolute basis. We've been thinking about risk. Very disciplined process. We try to remain true to the process and not let behavioral insights and affect how we pick stocks. And we have a track record now which is just north of 6 years. So how do we put together the flagship portfolio, which is the Morningstar MOAT portfolio? Firstly, I just wanted to point out this is a very plain vanilla portfolio. There's no performance fees, there's no initial fees, there's no leverage, derivatives or margin requirements. We're very benchmark agnostic. We're not looking to market time, but we're just looking to buy long-term investments in high quality stocks. And we define high quality as stocks with a wide and narrow moat that are trading at deep discounts to fair value. We rebalance every quarter, and when we sell a stock, we need a replacement to be at least 25% cheaper than the most expensive current holding to be added. So we're looking for deep discounts to try and limit turnover. And finally, we've applied a sector constraint, so plus or minus 5% relative to the ACWI index. We believe that active sector capping can enhance returns, improve diversification, and reduce risk. And that has actually proven very useful to not allow us to be too exposed to one particular theme or one particular sector. So how have they done? We hinted at it earlier in the introduction. The performance has been exceptional. So the portfolio has outperformed. These are gross of fee returns that we track internally. We've got different seed products that Saxo track for net of fee performance, but gross of fees we've outperformed by around 50% since launch, and it's delivered around a 14% annualized return. And you can see there the gap between the Saxo portfolio in euro terms relative to the all countries world index. And this year's also been a really strong year for the portfolios, and it's been pleasing that it's been in such a difficult year, how well the portfolio has held up. So the portfolio has outperformed the benchmark by around 8% and is actually flat for the year. And as you know, stocks generally have struggled, and the world index in euro terms at least is down around 8.3. So how has that been achieved? So we've run some attribution just to sort of highlight the kind of stocks that we're investing and the companies that we're backing to deliver returns for our clients. So firstly, the attribution is showing the outperformance this year has come from three main sources. Firstly, and generally it is stock selection. When you sector cap, so historically around 90% of our returns have been driven by stock selection rather than sectors. This year's slightly different just because of the vagaries of the market, but stock selection has been the dominant force again. So firstly, our investment in Ionis Pharmaceuticals, which is a California-based biotech firm, which is up 45%. So the last price was around $43. We've got a fair value of around $62, so a price to fair value of 0.7. It's a narrow moat firm with a 4-star rating. What it does, it's a leading developer of antisense technology to discover and develop new drugs. So there's a wide pipeline of drugs, emphasis on cardiovascular and metabolic diseases. Q3 numbers really strong, on track to meet our full year expectations, and the analyst reaffirmed that $62 fair value last week. The second key driver has been Dassault Aviation, which is a French military aircraft and business jet manufacturer, up 52% year to date. So those gains do mean that it's trading at a slightly closer to fair value than Ionis. So it's around 144 euros today. We've got a fair value of 171 euros, which represents around a 16% discount. So slightly closer to fair value, but it's still a 4-star stock. What it does, it's a subsidiary of the French multinational firm Dassault Group. It designs, builds, and maintains military fighter jets, which is around 70% of sales. No surprise in a year like we've had, where those products have been in demand. And one of the largest manufacturers of business jets is Falcon Division, which is around 30% of sales, and it also holds a 25% stake in Thales, which is another French aerospace firm, which contributes significantly to revenue. So these two are the two biggest contributors. And then overweight to energy. As you know, world energy stocks have been very strong this year. we've had an overweight by owning a couple of holdings through the year, and that's been the third main contributor to performance. What I wanted to show was some of the analytics around the portfolio as well. So you could see here Morningstar style box, and this is how we would analyze a portfolio, for any fund out there. So the squares at the top represent larger market cap stocks. Squares at the bottom represent smaller market cap stocks. The dots are the holdings. The red triangle is the benchmark, the ACWI, so it's a large cap sort of blend, and the red circle is where the portfolio sits. So you can see firstly it has a value bias, so squares to the left, so it's trading cheaper, typically buying stocks that are trading cheaper than their intrinsic value, but it does own some growth stocks. Those growth stocks are cheap relative to our fair value, and probably most pertinently, it's an all-cap portfolio, so we have a very strong mid and small cap bias. We have benefited from a significant amount of M&A over the 6 years. Those are likely to be taken out, and very often we've seen firms come in for a company and pay very close to our fair value estimate. I'm not saying that they read our research. Our research is very widely read, but that's sort of size bias and value bias are the two premium we're really trying to extract here in this portfolio. What's really interesting is where the portfolio is valued today. So as you know, we've had exceptional returns in the last couple of years, and normally that means that our portfolio is trading at richer valuation levels. So here every stock has a price to fair value. The lower the price to fair value, the bigger the discount, and we've tracked this at the portfolio level. So here we're now trading at around sort of half, 50% of its fair value, the portfolio, other things being equal. And it's periods like this in which we're looking to harvest gains and sow seeds for future returns. And we don't have a crystal ball. We can't predict what will happen in the market or in the macro world, but the figures do suggest that valuations are attractive enough. And we're actually seeing valuations now close to those we saw in the pandemic, and it was immediately after the pandemic is when we saw our strongest performance. If you use, we wanted to just show on a more standard conventional valuation metric, which is price to earnings ratio, and you can see again the portfolio in blue relative to the market, a decent discount. We're actually trading just below 10 times price to earnings, and so again under this lens, it's not a bad time to look at this portfolio. So one thing that investors are constantly talking about is active versus passive, and passive management has its place, and that predictability and certainty of returns is the price you pay for that predictability is positive and beneficial for many investors. But we have shown that you can deliver 4% annualized outperformance, does compound into very strong returns over a medium to long-term period. And what we're showing here is stock dispersion. So here we're comparing the 450th highest PE stock to the 50th. So if you think of the S&P 500 as 500 small pieces, we're taking the price to earnings of the 50th most expensive stock and relative to the price to earnings to the 50th cheapest stock. And you can see that dispersion is wide, much wider than normal. And in our view, this represents why it's a good environment for stock picking. When dispersion is wide, it tends to be a good environment for active fund managers, other things being equal. And I think another reason why we're pretty positive and why we're sort of, our multi-asset portfolio is also sort of trying to emphasize active managers where we can. If we look at positioning, you can see from a geographical basis, we're underweight the US. We have around half the portfolio exposed to US listed stocks, and overweight to Europe, developed Europe, and overweight to Asia, especially sort of Asia Pacific rather than Japan. Why is that? Again, it's just valuation grounds. We just see US equities are overvalued still relative to Europe and Asian stocks. And on a sector basis, you can see how tight we are running the portfolio relative to sectors. So we're trying to pick the best stocks within each sector just to reduce that tracking error, but we won't allow one sector to dominate. And the final chart that I was going to, before passing over to Mark, was just around the portfolio statistics. Quite a busy chart, but I'll just sort of walk you through it very slowly. So firstly, the style box value factors. So here you can see the portfolio relative to the benchmark. What we're showing is that under price to book, price to sales, price to cash flow, we are trading at discount to the broader market. The style box growth factors, the long-term earnings growth and historic earnings growth, suggests that our firms over the long term and historically have been growing earnings faster than the index. But what is interesting is the financial ratios at the bottom and how under that guide, the ROE, the ROA, the return on assets, return on equity, net margins are quite poor. This is how the portfolio works. What we're doing, in effect, is buying companies that are showing short-term, near-term stresses in their latest financial results often, but where we think that long-term picture is a lot more attractive, and they're cheap for a reason. While these stocks have wide and narrow moats, and we believe can generate supernormal profits for investors over the long term, they're often getting in that portfolio for a reason, and we are natural contrarians. And just wanted to walk through a couple more examples with you. I'll pass over to Mark to talk about the first one, which is Lloyd's.
Thanks, Mark. So Lloyd's is a predominantly UK bank. 95% of its assets come from the UK. It's one of the leading banks, leading franchises in the UK. It has around 1,300 branches, and it's one of the largest banks in Great Britain. It went through some pretty big restructuring following the last major recession in 2008, when it drastically reduced its risk-weighted assets, so the risk of its assets and its funding source shifting from wholesale to safer retail deposits. The UK market is a pretty well-balanced, rational market in banking at the moment. There are 5 core players: HSBC, Barclays, Santander, and Lloyd's. So between them, they make up roughly 60% of lending assets, which makes it pretty stable and a good competitive environment. The moat from Lloyd's comes really from two areas. The first is cost advantages. So this is linked to its funding source. So as mentioned, when it restructured and reduced the wholesale funding, it increased its retail deposits. So retail deposits tend to be cheaper than wholesale, for the simple reason that wholesale with institutions will be much more sensitive to the rates they get, whereas retail depositors are less sensitive. This is also linked to the second competitive advantage, switching costs, which again is linked to this deposit source. That retail depositors are very unlikely to switch banks to get an extra 10 or 20 bips in interest, whereas large wholesalers and institutions will definitely do that, which makes it a stickier source for Lloyd's. So as Mark mentioned, there's usually short-term concerns with these stocks. So there's concerns around recessions in the UK, but we think that the bank is in a much better position than it was in the previous recession in 2008. Its Capital One ratio is around 14.8%, and this means this is the amount of equity it has over its assets, which are adjusted for their riskiness effectively. And the minimum requirement is 4.5%, so there's plenty of room above that. And even if you take into account the extra buffers there's the capital conservation buffer of 2.5%, and the counter-cyclical buffer, which is currently 0% in the UK, but will be increasing in December to 1%. But even if you include these buffers, it's still well above this. And this buffer really affects the ability of banks to pay distributions rather than the need to raise capital. The other thing which is sort of interesting with Lloyds at the moment is the relationship with interest rates. So the management believe that as base rates or interest rates in the UK rise, that their net interest margins will rise, giving them more profit at the bottom line. And I think the relationship with interest rates and the interest margins is fairly complicated and not always that simple. But I think one of the things that it's linked to is its funding source. So this goes back to its MOAT. So effectively, the interest margin is determined by the interest income and the interest expense a bank earns, and the sensitivity of those to interest rates. And when you have when your deposits are largely coming from institutions and wholesales, they'll tend to be very sensitive. So when interest rates go up, they'll also expect higher interest rates, and that can actually make the relationship with the interest margins fairly poor. But in Lloyd's case, given they have such a large retail deposit, it's likely that the interest expense will lag the interest income, leading to a potentially positive increase in the interest margins. On the next slide, we have BMW. So BMW is a German auto manufacturer of vehicles and motorbikes. They are one of the leading brands in the premium section of the market. Well-known brands BMW, Mini, and Rolls-Royce are in their portfolio. So they benefit from numerous things. As emerging markets become more affluent and people want more luxury products, they naturally benefit from that, as well as their kind of global scale. I think they have around 13 production globally, around production in 13 countries, and around sales in 140 countries with a wide distribution network. And I think this success can be seen at the market generally over the last 15 years has risen around 2.5% compared to BMW at around 6%. And partly the reason for this is its MOAT. So it's just that strong brand. It's linked to intangible assets. It's a global brand, well known, well regarded, won considerable awards every year. And I think this is also seen in its ability to constantly generate returns above its cost of capital, averaging around 8%. And again, BMW has some short-term concerns. There's supply issues with chip shortages. There's issues with what's happening in the COVID lockdowns in China, still affecting the economy and having effects on BMW, and of course just increasing inflation and the parts for vehicles. Having said that, the MOATs are assigned on a long-term basis, and that's what drives returns ultimately. And we still believe it's a very high-quality company, and that in the long run, it will be able to look through these currently short-term concerns which the market is focusing on. And with that, I'll hand it back to Mark.
That's great. Thanks, Mark. So two really good examples. And on the banking side, we're definitely, for our multi-asset portfolios, we've been we're moving quite overweight world financials, European financials. We definitely see a real opportunity there from a sector perspective. So I wanted to use the last 10 minutes of our time before moving to Q&A on our high dividend portfolio, which is the second product that we have built for Saxo. It's a similar product in the fact that it's investing in wide and narrow moat stocks. This time, we're from a valuation standpoint, we're emphasizing the star rating. So it's a similar valuation measure to the price to fair value, but it does incorporate risk. We have 1, 2, 3, 4, and 5-star stocks. Every stock is designated one of those 5, and we're only investing in 3 stars or higher. And then we, from that basis, we conduct some screens. Firstly, and we're quite rigorous screens, so it does reduce the universe quite significantly. Firstly, we will only invest in a stock, in a company that has paid at least 10 years of continuous dividend payments. We want that company to have grown the dividend for at least 5 years. And finally, we do check to see whether that company has sort of the earnings to cover that dividend, and we compare it to the industry average. So we drill down into the below the sector level just to double check that they have decent earnings, and we look at the balance sheet of the company, and that does bring us quite further down, reduce the universe quite significantly. Performance again has been really good. We've outperformed by around 10%. We launched these portfolios back in 2018, and you can see there this does come after a pretty difficult COVID period. So if you just a bit of background, if you remember during the COVID, the beginnings of the pandemic, for many firms, the regulator for a lot of the sort of banking sector, especially, and other sort of systemically important sectors, the authorities told them that they couldn't pay dividends. So all the banks, for example, in Europe and UK were told that they had to suspend dividends. This, we needed to analyze this. We actually did some work, spoke to our analysts, and if we saw that for example, HSBC, if we saw they had adequate earnings to pay that, it was more of a regulatory requirement. We decided to keep the stock, but we did see some near-term weakness at that point. But then since then, the portfolio has just generated some fantastic returns. We were vilified in terms of keeping those stocks because almost all of them did return back to the dividend register. And we've actually seen very strong performance as a result, and actually stronger returns since COVID than the MOAT portfolio. And again this year has been a great period for equity income investing, and the portfolio is up around 4.5%, which represents around a 13% outperformance. What's driven that? Again, we've got stock selection that are driving it, and a lot of that is coming from the consumer cyclical sector. So if you think about consumer cyclicals in a world of high inflation and slowing growth, in aggregate, that sector is down 20% this year. Our blend of stocks is up 31% in the consumer cyclical sector. And it just shows you what stock picking and what active management can do if you get that right. So the first source was Amcor, which develops and produces flexible and rigid plastic packaging and services. That packaging services the food, the beverage, the pharmaceutical, and the industrial sectors, among others. Half its group sales from the US, a quarter from Europe, and the rest from emerging markets. It has a narrow MOAT rating. We put that little star because we did sell that mid-year at an 11% gain, and actually the stock has sold off a little bit after we've sold it. And it currently offers a 4% dividend yield, and it's around flat year to date. The other two we do still own, and they're still held in the portfolio. That's Genuine Parts and McDonald's. Genuine Parts, they sell automotive parts, which is around 2/3 of net sales, to commercial and retail customers through around 10,000 stores worldwide. And it's been delivering solid earnings. Quarterly sales rose about 9% in the automotive unit this year, 35% in the industrial group. And it has been successfully being able to pass the cost increases along to its customers. That rally has meant that the stock is now trading above our fair value, and it's now a 2-star stock with only a dividend yield less than 2%. It's been a real winner for us, and it's likely we're going to sell that at the next semi-annual rebalance. McDonald's is the fast food chain. It needs no introduction. Has actually seen strong year-to-date performance. It's pushed it above its price target. Heavily investing in technologies, rolling out a loyalty program. The menus are evolving. Yield is around 2, so another candidate for sale, but have been a fantastic investment this year. And then secondly, World Energy again, as that overweight has helped us to deliver some performance. Again, here's the metrics. Highlighted the dividend yield, so a 6% plus dividend yield, which is a really attractive level. We think it's trading at a discount, although not quite as steep discounts on price to book or price to sell, but lower growth and lower historical earnings growth. These are more stable, mature businesses that are growing slower than peers. Here's the star box. Just thought it'd be nice just to show you the difference between the two portfolios. So the high dividend on the left has a larger cap bias, deeper value, whilst the mainly because it just lacks those growth stocks that Morningstar MOAT does invest in, which is more mid cap. And finally, we've just put some metrics side by side. So upside downside capture. So Morningstar MOAT definitely does generate this performance on the upside, and it's 1-to-1 on the downside. This is over the last 3 years. Morningstar high dividend has a lower beta return, and a lot of its return has been over the last 3 years has been captured by that lower downside capture ratio, and that does include the COVID period. Volatility is a lot lower. The alpha is higher for Morningstar MOAT, and you can see that from a market cap bias, all cap versus large. So why invest? Just the key takeaways before I open it up for questions. 100 robust, repeatable investment process, 100 equity research analysts powering this. Got a very simple, rules-based approach to rebalancing an investment. We're independent-minded. We're not scared of thinking differently than the street, and holding our fair values very rigidly where we think that the long-term value lies. We've got a proven track record and transparent competitive management fees. And just think about the key takeaways. There is a lot of macro uncertainty, and I'm happy to touch on that if there's any questions, but cycles do happen. And we like to take the temperature of the market. So when it's cold, we think it's pretty cold at the moment, we will be looking to buy, and when it's hot, we'll be looking to sell. So in our multi-asset portfolios, we've been adding to risk this year. We've been adding to equities. We've been adding to cyclical parts of the market. We've been adding to bonds. Emotion is the enemy, and it's okay to be afraid and uncomfortable, but we've hopefully shown you that the portfolio itself is trading at a deep discount to its fair value, and history does suggest that is a pretty good time for future returns. You should retain focused on your long-term financial objectives, and we don't think success in investing is not from buying good things, but buying things well. And we run a valuation discipline in all our portfolios at Morningstar Investment Management across the multi-asset and the equity space. And finally, just these aren't, just to reiterate, these are sort of standard global equity portfolios. So there's, you don't have to pay to wait. There's no sort of margin calls, etc. So, even if the market does exhibit some more volatility over the next few months, the portfolio is sufficiently cheap. It may get a little bit cheaper, but we think it's a fantastic, those future returns we're really excited about. And we're very excited about our partnership with Saxo as well, and proud of what we've achieved so far. But with that, I will pass it back across.
Brilliant. Thank you very much, both Marks. Really insightful and entertaining presentation there. There's a couple of questions I just want to answer now before we dive into the Q&A. The first one is from Simi, and Simi's asked a very good question. Where can I find the fund fact sheets for both of the funds? So the answer to that is they are both available on our UK and international websites. Just type in Saxo Morningstar fact sheet and it'll come up on as the first result. Secondly, if you are already an existing client, I'd actually advise you to head straight to your investing platform. We've got SaxoSelect available on Go and Pro, and also the Saxo Investor platform. Just click on SaxoSelect, take a 30 seconds questionnaire, and you'll be able to view much more information on the Morningstar portfolios there. And do bear in mind as well, it is actually a portfolio, not a fund, which is a great thing. So it means that you can view all the positions which the Morningstar team are managing for you, rather than a fund, which will only show you maybe the top 10. And there was a second question as well from Annie, and that is, where will you receive the slide deck for today? And that is actually available to you already on the handouts tab, top right hand corner of your screen, and also you will receive an email with the PDF attached within a couple of hours after the webinar. Okay, so let me return back to the Q&A then. Both Mark, so I'll leave this question both at you, and you can decide who's best answer. So top of the mind for clients now is stuff like inflation and interest rates. The current, or I should say the last couple of quarters have been rather turbulent. Interest rates are increasing, as is inflation. We're starting to see a little bit of a flattening of both. How do you think both portfolios are going to perform over the next, let's say, couple of years, if we are to remain in a similar macro environment as we are in today?
I mean, I'll pick up that. So, I think firstly, what I would say is that the portfolios behave with a kind of an idiosyncratic manner, especially the MOAT portfolio. It's very difficult to sort of pigeonhole it into it likes one scenario over another, and that's mainly driven by that sector, those sector limits. But firstly, we've had a period of rising rates and rising inflation, and it's actually been the best period for these two portfolios since we've launched them. So there's one answer. Not saying that's going to happen. You can't guarantee that going forward, but we've tended to. It has this world we're living in looks more beneficial for sort of a value style of investing. And when we have technology stocks in both, they are we've been adding very, very cheap ones and selling stocks which were to fund that was maybe a couple of years ago, which were quite sort of mature, well known, and weren't none of the sort of really racy runaway names that you might see on the Wall Street Bets forum or something like that. So we're pretty comfortable with how the portfolio is positioned. We have a large weight in banks in both portfolios, which should benefit from rising rate environments, and we have the energy stocks, and we have some sort of firms that benefit from sort of high inflation. We are seeing the one factor that I would point out is our Asia exposure. So we've been quite pushing into, so we own Taiwan Semiconductors, we own Hong Kong Lands, we own Tencent, we own Alibaba. So we have taken some positions in Asia based on very, very cheap valuations. So there's a sort of idiosyncratic risk there. But generally, we would point to how we've done in this environment is the best answer I can give.
Brilliant. Thanks for the in-depth answer there, Mark. I see a couple more questions popping through. So today there is a line between maybe the line between growth and value has blurred somewhat. You know, former growth technology companies have seen their growth rates come under pressure, tailwind from COVID or global supply chains, whatever it may be. But ultimately, growth stocks might have turned into value now. So has that had a positive effect on the pool of stocks that you can invest in?
I mean, it's definitely changed the makeup of them. So we used to struggle to find technology names to populate the portfolio just because of the valuations were just so stretched. You know, we had stocks that were trading at 2-3 times our fair value, and we were putting in stocks maybe trading at sort of 15% discounts, 20% discounts. Today we've just got a long list of names. And so the questioner is quite right. There's a much broader list. And I think what's interesting, though, is that there is stock differentiation. Our analysts, it's not everything is cheap. So we quite like Meta from a valuation perspective, maybe a little bit less so on Apple. And we can really see that differentiation from a price to fair value. So I think just in our view, just buying the NASDAQ or buying the FANGs, I think that game is kind of up. Those are just sort of amalgamate. Each has its own sort of future outlook, and I think our analysts are sort of leaning us into certain names and steering us away from other names.
Got it. Very clear. There's a question which I knew would come up today. From Ivan, and he's asked, are we at the bottom of the market?
Well, yeah. I mean, it's very difficult to say. If you put 20 economists in a room, you get 30 different macro views, and a good strategist has 10 market bottoms. It's difficult to say. I mean, we're definitely seeing inflation pressures easing. We can see it with gas prices. We can see it with economic activity. We can see it with consumer confidence. The risk is around wage inflation and labour markets, and we'll see what this round of pay negotiations lead to. We're getting strikes, etc. But if we do see easing inflation, we can see central banks taking their foot off the gas, foot off the interest rate hiking cycle, and maybe it is the bottom. But I think there's a huge amount of uncertainty there. All I can say from a we run multi-asset portfolio. I'm a multi-asset portfolio manager as well, and we are adding risk to our portfolios. But to say it's the bottom, I just I don't want to sort of make this bold prognosis, and I think that's it will be a guessing game. But some of those pressures are easing when we look at the data.
Got it. Yeah, it'd be a big claim to say that we're at market bottom. I suppose a key learning is diversify. Yeah. So another question just popped through. So looking at valuation and dividends, have you looked at China unicorns? And what's your take on China stock?
So we are. I mean, I just sort of hinted at it before. We are overweight China in our multi-asset portfolios, and we've been adding them to our these stock baskets as well. There's, we know the story. Zero COVID, the Common Prosperity initiative, and the game has changed for some of the bigger tech firms, which frankly won't be able to buy their way into growth, and they're looking, the 10 cents and are looking to divest rather than to grow, and they have to grow organically, which is a lot harder. But if you just on the face of it, it's just a couple of stats, China's weight in the MSCI All Countries World Index is around 3.5. Apple's weight is around 4.5. So you have a one stock with a market cap more than the entire nation's market cap. And the second interesting stat is that Chinese government debt is now 9% of the global aggregate bond index. And this is a country with one of the lowest debt to GDP levels in the developed and emerging market world. And so that's just the size of the economy relative to the size of the market capitalization. And we're seeing them slowly watering down the COVID initiatives, and the next summit will be in March, the economic meeting, and we would expect to see some positive announcements there. So for us, for a long-term perspective, if you're willing to sort of take a long-term view, valuations are incredibly cheap for a lot of these names. So we're very excited by Chinese investments right now.
Great stuff. Great stuff. And final question here is Sarah is very interested at getting into investing. He wants to learn more about value investing and that style and that approach. Do you have any recommended books in value investing, or maybe investing in general?
Yeah, we've got a book club that we run internally, and we've seen quite a few of these books. So currently one we're reading is One Up on Wall Street by Peter Lynch, who's one of the sort of better known US equity fund managers in the 80s. Pretty accessible. Howard Marks, Most Important Thing is a fantastic book. I mean, if you really want to get into it, Benjamin Graham's Security Analysis is a really interesting read, and we actually sort of modeled some of the principles behind the dividend portfolio, as well as tapping into some fund managers we knew for that product. What else would I say? Mark, you're leading a couple.
Margin of Safety by Seth Klarman is also a sort of a classic, great kind of introduction into our thinking.
Yeah, I knew you'd say that. That's your favorite. So yeah, we're happy to share a list if you want. If anybody wants to, we can send our reading list over. Some really interesting books there.
Yeah, I'm sure that would be relevant. Give people a lot of reading to do over Christmas. I know I've added the Peter Lynch book to my festive reading schedule. Okay, so so we've got 1 minute left. So very, very quickly, I'm going to share the risk disclaimer on screen and take a little read through that anyway, so you are aware of the risks and whatnot involved with investing and everything you've heard today. Just as a last point for myself, in terms of if you are interested in learning more or investing into one of the Morningstar Saxo portfolios, please head directly to your Saxo platform, where you can read a lot more information there before you invest. And minimum investment size for both portfolios is 30,000 euros or US dollars, depending on where you are living, with costs around 1.2% per annum, approximately. But both Marks, thank you so much for your time and input today. It's been invaluable, and I'm sure a similar webinar will be happening again in 2023. So everyone on the call, please keep up to date with the webinar tab on your Saxo platform and on the Saxo websites. There's a lot more good content coming your way. Thanks again. Enjoy your day.
Are we off?